welcome to Hilltop Wealth Advisors Economic and Market Update for the second quarter of 2023. I'm Rusty Erickson, and here with me today is David Wise. David, thanks so much for joining.
Absolutely. It's always good to talk about the markets and the economy. Never a dull moment.
Oh, for sure. So why don't we jump right into it? Tell us about what happened in the second quarter.
Absolutely. I think overall this year, it's been a surprising start, and we saw that continue in the second quarter, and markets remain strong despite some of the hard-hitting headlines we've experienced. Looking backwards the last several months, we've gone through a lot. I mean, regional banking crisis, the debt ceiling standoff. We recently were downgraded as far as our U.S. debt by one rating agency, and even with all of that, we felt like coming into the year, the markets would be trading off of inflation and interest rates. What happened there would really dictate where the market goes. And fortunately, inflation continues to cool, decelerate, which means we're getting closer to this ever so important, the end of the interest rate hike cycle, which is good for the markets, and we've seen that. In addition, the economy remains much more resilient than I think a lot of folks anticipated. That's been really led by a stronger consumer and a stronger labor market. Stock markets, both here in the U.S. and internationally, have really been off to a strong start. Abroad, that's been led by mostly Europe and Japan. Here in the U.S., at first glance, I think when you look at this awesome run-up that we've had, it's been remarkable, and that's coming off of a pretty dismal 2022 campaign. But if you read the tea leaves, when I dig into the details, we find that this rebound is far from broad in scope, but it's actually very narrow. In particular, technology and communications, and a big boost from some of the excitement we're hearing from artificial intelligence has really led the way. So the Magnificent Seven, those larger corporations that have been all the buzz, Apple, Microsoft, Tesla, NVIDIA, to name a few, have really been leading the charge. And you can see in this chart, the top 10 companies in the S&P 500 are actually responsible for roughly 75% of the market returns year to date.
Absolutely. It's amazing to see how much of the returns can be attributed to just those handful of names. But also, when you think about the corollary to that, those handful of companies now represent such a significant part of the S&P 500 as they've continued to grow and their equity value has increased.
Absolutely. So we're paying a close attention to valuations, particularly in that sector of the markets. And that could point to maybe some choppy waters ahead. Maybe, Rusty, you could jump in and talk about our outlook moving forward for the remainder of this year.
Yeah, absolutely. I'd love to talk about our outlook and some of the risks that we see. And I think there are kind of three main areas that we'd like to talk about. One is bonds and cash. And this is an area that for many years was pretty low yielding, but now with interest rates being higher, there's an opportunity to earn more, not only on the bonds and the portfolio, but also on cash reserves at the bank. And for many of our clients, they're earning more interest than they're paying. And so higher interest rates that we're experiencing now can be a real benefit.
Absolutely. It's about time that cash did something for us, right, Rusty? So if you're out there and your bank's not paying you 4%, you probably should give them a call.
I would agree with that. I think secondly, if we look at the U.S., we are cautiously optimistic that some of the things we saw in the first quarter and second quarter of this year continue into the second half of the year. So a really resilient economy, strong labor market, as well as inflation going down. We continue to see recessionary risks, but if we continue to have a strong consumer and a strong labor market, it could mean that recession is a lot milder than the recessions we've seen in the past. But some of the risks that we think about, certainly inflation. Inflation could be much stickier than anticipated, and that could have some negative consequences. Also, along with that, the Federal Reserve has a tough job with monetary policy, right? They need to raise interest rates enough to really start to bring down inflation, but not so much that it curtails economic growth. But also, they don't want to undershoot, right, to where inflation is higher than what is good for the economy. So they've got a tough job. I think that's worth remembering as well when we think about the outlook.
Absolutely. And I think, when you look at it internationally, so across the pond, what are we seeing there in a similar boat?
Yeah, I think some of those themes definitely continue. So cautious optimism that some of those positive trends will continue. But I think there are more unknowns and there are some more risks, which is
Hmm.
why international markets, in our view, continue to be very attractive right now when we look at valuations and why they're still part of the portfolio. But some of those things that we're thinking about, one, geopolitical risk, not only within Asia, but certainly Russia and Ukraine as
Hmm.
well. You think about the world's second largest economy, China. They have seen growth this year, but it's been below expectation. For example,
Yep.
second quarter GDP came in 1% below analyst expectations. So hopefully we'll continue to see growth there. Also, China is implementing some stimulus. So hopefully that stimulus will be effective and will lead to some growth for them as well.
Yes.
And then lastly, if we think about the United Kingdom and the European Union, they're facing higher inflation like we are in the US. However, one key difference is their underlying economies are not as strong, which may
Mm.
mean that the Bank of England and the European Central Bank have some tough decisions to make on how aggressively they fight inflation, knowing that if they raise interest rates to really effectively fight inflation, that could have a significant impact on economic growth and curtail that. So they've got a tough job as well.
Yes, they do. Yes, they do.
Yeah, for sure. So with those thoughts on where we are and our outlook and some of the risks, that definitely informs our portfolio positioning. So David,
Hmm.
why don't you talk a little bit about how we're positioned right now?
Yeah, I think we've loved the recovery we've seen. We love to see the markets trending in the right direction, but we think it's a little premature to celebrate this bull market and think that there's not going to be some choppiness ahead of us and volatility with all the known risks and unknown risks. I think in the near term, right, we're favoring more defensive sectors like healthcare, and we want to stay um, in a space and have an overweight to larger capitalization companies here, both in the U.S. and internationally. In the long term, we think emerging markets can outperform, but at this point in time, we want to stay larger in our capitalization. Want to stay a little more defensive in our alternatives, and we're hoping that will bode well over the course of the next 6 to 9 months. And if we do see some volatility and a pullback, which we kind of are expecting, then we'll look to take advantage of any of the opportunities that present themselves at that point in time and maybe dial up our risk profile to attempt to capture more of the upside. We're just not, don't think that the markets are quite out of the water just yet. And when we think about investing in general, we mentioned cash. We always recommend having a strong cash reserve. Make sure you're earning good yield on your cash accounts. Call your bank if you're not. Outside of cash, we always want folks to keep in mind, keep the long term in mind, remain diversified, stay invested, and last but not least, always keep saving, no matter what's happening with the economy or the markets.
Yeah, absolutely. And I really appreciate you, David, mentioning some of those things that are really core principles to us here at Hilltop. We never can hear them too often, like have a good cash reserve, remain focused
Hmm.
on the long term, have a process, et cetera. So thanks for mentioning those
Hmm.
things. And yeah,
Absolutely.
thanks for joining me today. Thanks for talking about these
Yeah.
items. And thank you all for watching. We hope you've enjoyed it. Hope you have learned some things as well. If you're not already working with Hilltop, we'd love to get to know you. One of the ways that you all can get to know us is by checking out our website, hilltopwealthadvisors.com. So thanks again, David. Appreciate it. And until we talk
Absolutely.
again.
Absolutely. See you next time.